convertible debt or convertible loan note. When founders are getting going, and sometimes at later stages, they will often issue promises for equity in the company in the form of a convertible debt. Investors will give cash to the company with the option of converting that from a loan note into equity at the option of the investor, but where it's also an expectation of the investor that the note will be converted into equity in the company down the line. Why would somebody invest in convertible debt or a convertible loan note rather than just, which is also called CLN, rather than just investing in straight equity? It's because a lot of the times founders don't want to value the company at the current price or the current valuation of the company. They want to defer the discussion about the price of the future value of the company until a later date, because they recognize that it's early stages and they haven't really proven that there's a lot of value in just the idea. So as a way of getting investors individually to be able to commit without having to have a fixed priced round, they'll get a number of investors to individually commit. I'll put in $25,000, I'll put in $50,000, I'll put in $250,000, and they share some notes, they get the money at different times, and then when they finally do have a fixed price round, they convert all those convertible loan notes into one equity investment at that future date. So there are those two different purposes that convertible debt, convertible loan notes are primarily useful for. Number one, for facilitating the ease of getting a number of different investors to invest capital at different times, and two, to defer the conversation about what the actual price of the company is worth today. Often when a company is looking to raise, say, $500,000, they're going to do it in small chunks. They may get one sort of quasi-lead investor to put in $250,000 or $300,000, but they'll probably find some family and friends and others that will say, yeah, we like this. Some angel investors, typically, that'll put in $20,000 checks each, and they will make their decisions individually, not as a group, not as a institutional investor would, that would say, okay, we're going to do this all in one go. But over the course of a couple of months, people would say, oh, I'll put in $20,000, and here's my check, and here's the convertible loan note, and when it converts, give me a call, send me my shares, etc. So that's very commonplace in around, say, $500,000, that will be done instead of as a fixed price round at a set valuation. It'll be done as this convertible loan note structure, which will wait to be priced until that fixed price round happens. There may be, in many cases, the angels will want to make sure that the valuation they're investing at does not go higher than is reasonable to them. If a founder was to go around and collect a lot of checks and a lot more checks and a lot more checks and never price a round until years into the business, well, the valuation of the business 3 years in, even though he grew off the back of all the angel money or other investors' money in the first place, the price could actually be worth, say, $20 million. The whole value of the company could grow if they're doing tens of millions in revenue. It could be $20 million or even more. But the angels that initially backed the company, that initially funded the company, if they didn't have a cap on the valuation of the company that they were investing in, when it did convert to a fixed price round, they would be getting a very, very tiny portion of the shares of the company, not reflecting the risk that they put into the company. That is convertible loan notes.
VC Lingo. Lingo.